Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. I'm on the web at elevationfinancial.com. Welcome, glad you're here. Today we're going to talk about dollar cost averaging versus lump sum investing and which strategy wins. What should you do? Spoiler alert, the answer is always it depends, but let's talk about it. So when you have a lot of cash to invest, sometimes you might kind of face a tough decision, which is should you invest it all at once or should you spread the amount out over time when you're investing it? This has sparked a bunch of debate among investors, financial advisors, researchers. So what does the data tell us about these two approaches, dollar cost averaging versus lump sum investing? So let's talk about what they are first. Lump sum investing. So lump sum investing is pretty straightforward. You take your entire investment capital and you invest it into the market immediately in a single transaction. So for example, let's say you receive a $60,000 inheritance. A lump sum approach might mean investing all $60,000 on day one. So you're taking that entire $60,000, you're investing it all at once, just dumping it in the market. The logic is pretty simple. If the market generally trends up over time, the sooner your money is invested, the sooner it can start working for you. So, you might think every day your cash sits on the sidelines is a day you're potentially missing out on market gains. Pretty logical, right? So let's talk about dollar cost averaging, or DCA for short. So when I say DCA, that's dollar cost averaging. So I might use them interchangeably. Dollar cost averaging is DCA. So dollar cost averaging involves dividing your investment capital into equal portions and investing those portions at regular intervals over a predetermined period. So if we use that same $60,000, you might invest $5,000 per month for 12 months, or maybe $1,250 per week for approximately 1 year. So the appeal of DCA lies in the perceived risk reduction. So by spreading the investment out over time, you buy more shares when prices are lower and fewer shares when prices are high. And that potentially lowers your average cost per share. Also provides psychological comfort, especially during volatile markets, because you're not risking everything at what might turn out to be a market peak in that time period. So what does the research show between these two approaches? So a lot of people are wondering, well, what strategy produces better returns? So here are some of the answers to that backed by some research. So first of all, the bottom line is lump sum usually does win. Multiple academic studies have demonstrated that lump sum investing outperforms dollar cost averaging approximately 2/3 to 3/4 of the time. There's a 2012 Vanguard study that analyzed historical data across three major markets, the US, UK, and Australia over 10-year rolling periods, and found that lump sum investing outperformed dollar cost averaging roughly 67% of the time. The margin of outperformance varies depending on the asset allocation, but for typical balanced portfolio, let's say 60-40, which is 60% stocks, 40% bonds, lump sum investing generated average returns about 2.3% higher than DCA strategies over the 12-month period. So why does lump sum investing tend to win? The primary reason is that markets rise more often than they fall. That's the bottom line. Historical data shows that U.S. markets have positive returns in approximately 70 to 75% of all 12-month periods. So when markets are climbing, having your full investment working from day one captures more of that upward momentum. But when does dollar cost averaging outperform? So dollar cost averaging shines in specific scenarios, generally during sustained market declines or periods of high volatility. If you happen to implement a DCA strategy starting in early 2008, just before the financial crisis, you would have outperformed a lump sum investment made at that same starting point. By continuing to invest during the downturn, dollar cost averaging investors bought shares at progressively lower prices, and that positioned them for stronger returns during the eventual recovery. In a similar fashion, during the 2000 to 2002 dot-com crash or at the start of the 2020 pandemic downturn, DCA strategies would have delivered better results compared to lump sum made just before those declines. But let's talk about the magnitude of difference. So the return differential between the two strategies, while favoring lump sum investing, is often a lot smaller than you might expect. In that Vanguard study, when you look at the 12-month DCA periods versus an immediate lump sum investment, for all equity portfolios, meaning all stocks, lump sum investing averaged 2.4% higher returns. For a balanced 60-40 portfolio, the advantage was around 1.8 to 2.3% higher. And for conservative portfolios with more bonds, the difference was even smaller. So not that much of a difference. These are averages. So keep in mind, in individual scenarios, the differences can be much larger in either direction or smaller. And so, for example, an investor who invested a lump sum just before a major crash might lag significantly, while someone who invested a lump sum at the start of a strong bull market might see returns exceeding what DCA would have produced. So it varies, of course. So let's talk about the risk factor, however. So lump sum investing, again, does typically produce higher returns, but there's some nuance there when we talk about risk-adjusted returns and behavior. So when it comes to volatility and drawdowns, dollar cost averaging does reduce short-term portfolio volatility during the investment period because you're not fully exposed to the market and your portfolio experiences smaller fluctuations because you've got some in cash. So if you have a lower risk tolerance, this smoother ride might be worth the potential return sacrifice. So the psychological factor is important, and it's probably the most underappreciated aspect of the debate, because studies show that many investors who commit to lump sum investing later end up panicking during market volatility, and they sell at the worst possible time. So if dollar cost averaging helps you stay invested during market volatility, it's probably worth the tiny potential trade-off in difference in returns because you're keeping with your discipline more. You're keeping invested. You're staying invested. The best investment strategy is the one you're going to stick with, ultimately. If DCA makes you more comfortable and you're more likely to stick with your investment plan through market ups and downs, it might produce better real-world results because you stay invested. So when you're making your decision, first, obviously be aware that mathematically the evidence does support lump sum investing, but your personal situation is really what matters. So, think about lump sum investing if your risk tolerance is high, your time horizon is long, and you've got the stomach to watch your investment potentially decline in value shortly after investing. So if you can avoid constantly checking your portfolio, and instead you can trust long-term market returns, lump sum investing is probably going to be a good move for you. However, maybe you should consider dollar cost averaging if your investment, the sum you're investing represents a large portion of your net worth. It's a big deal to you. Maybe you're new to investing. Maybe the thought of investing everything at once just sounds scary. It causes anxiety. The peace of mind of doing dollar cost averaging is worth it. That's probably more valuable than trying to squeeze out higher returns with lump sum investing. Some people like a middle ground. You can take half of your lump sum, invest it in the market immediately, and then take the other half in dollar cost average over several months or even years. That hybrid approach captures some of the advantage of lump sum investing while providing some of the psychological comfort of dollar cost averaging. So again, while lump sum investing wins on paper about 2/3 of the time with slightly higher returns, dollar cost averaging is not wrong. It's not a mistake. Again, the best investment strategy is the one you can stick with through all market conditions. So if you have the cash to invest, the data leans toward putting it to work immediately. But if spreading your investments over time helps you sleep better at night and keeps you from making emotional decisions during market turmoil, then dollar cost averaging could be the right choice for you. So hope that's helpful. Bottom line is neither one's wrong. That's the bottom line. All right. So with that, please feel free to reach out anytime with questions. I pretty much on any social media platform you can find. And of course, my website's the best way to find me, which is elevationfinancial.com. You can send me a message through my website, or if you'd like to talk in real time, schedule a free consultation using that button on my website. All right, everyone. Thanks for joining me today. Have a great day. We'll see you next time.